Welcome to the daily update, where I'll go over the action in the market for Tuesday, May 6th, and we'll see how things look for Wednesday, May 7th. The decline continues. We're still positive in the short and intermediate term. We're still above the 20 period moving average, but we're coming back down to the 20 period moving average, so we're no longer extreme. It still looks, for right now, like we're just pulling back. If we see more from here, then we'll have to just evaluate it as it unfolds and see if it's turning into something more than that. So we just kind of take it day by day. Now, on Wednesday at 2 p.m. Eastern, that is when the Fed is going to come out with their announcement. And they're not, it's pretty much a sure thing that they won't change interest rates, but they'll be making statements and there's a press conference and the market will be trying to figure out, is there any hidden meaning to all of that, and may end up reacting. Okay, so let's go back and talk about right at the open. We were down with the futures and that produced a gap lower open below S2 at 5607. So now we're back to dealing with the 5600 level. Last Friday, we were dealing with the 5700 level, and that was providing overhead resistance. We did drop below 5600, but then we were able to come back above that. There might have been some stop loss orders there. Get me out of the market if we drop below this level, kind of a thing. That's a little trick that can happen from time to time. It's called gunning for stops. Come down, clear out all those stop loss orders, and then turn around and go the other way. It's a pretty common thing. But we were able to rise back above S2. We got up to S1 at 56.29 and almost to the unchanged level. Again, we saw that in Monday's session. That is an overhead resistance area when we're having a down day. Then we declined back below S1 and S2. Then we climbed back to S1, but then ended up closing down at S2. So it was a little bit of a roller coaster day. We were down 0.77% on below average volume. We're still seeing that, whether it's an up day or a down day. Volume has been dropping off. And we are positive in the short and intermediate term, still negative in the long term because we're below the 200-day simple moving average and we're in a downtrend there. Interest rates did come back down a little bit. That the bond market still appears to be fairly stabilized at this point. And then as far as geopolitical events, it's what's coming out of Washington, D.C. with the tariffs and the trade war. There was a terrorist attack over the weekend in Israel. The U.S. and Israel have been fighting back against the Houthis. Apparently, they did a really good job because they took out some blowfish too. And now, my understanding is the Houthis said, okay, we're not going to do this anymore. We will stop with our attacks, which is pretty much what was wanted. And the U.S. has come out and said, well, if you stop trying to put bombs into Israel, we'll stop bombing you. I mean, it's a pretty simple cause and effect there. But just keeping an eye on that whole situation in case it does escalate and have impact on the stock market. All right, some comments. The pullback still continues. And for right now, it still looks like a pullback. Now, there are some things that are concerning us, and that's why I'll go through the charts and show you these things. There are some renewed tariff concerns and cautious corporate guidance. That's kind of, it's like, okay, the last couple of weeks, things were looking a little bit better. Now, maybe some second guessing and second thoughts are coming into the picture. Maybe there are some things we need to be worried about. And then, as far as corporate guidance with earnings looking forward, there's even some companies here, Ford and Mattel, they didn't provide full year guidance. It's like, we don't know what's going to happen here. So we can't really tell you what our earnings are going to be going off into the future. Ford warned that the tariffs may cut 1.5 billion from its profits. Mattel acknowledged that a volatile macro environment that just makes it more difficult for them. And you're going to have to pay more for your Mattel toys. President Trump announced impending pharmaceutical tariffs expected to be detailed within the next few weeks. And then Treasury Secretary Bessent came out and said that trade deals could be announced as early as this week, and up to 90% of the deals could be completed by the end of the year. Again, just throwing things out there, nothing concrete, nothing definite, just bits of hope that seem to be coming out right now. And since we're declining, the VIX is going back up. We're above 24 at 24.76. And our list is getting shorter. We're working off some of this short-term overbought condition. And some of the momentum is coming off too, where we just have the Williams percent R. The Stochk RSI, that's come off the list. And both the CCI charts, those are off the list now, but we still have the stochastics, the rate of change going back 10 and 20 periods, and the slope oscillator. In the intermediate term, a shorter list. The TTM squeeze is still extreme, but starting to turn more negative. The PMO studies, these take a little bit longer to develop, so they're still we still have one area extreme there. And the bullish percent index for the S&P, that's off the list now, but the Nasdaq 100 bullish percent index, that's still on. No change to the scenario. We'll see after the meeting on Wednesday what they say, what it looks like they're worried about, and we'll adjust this scenario if needed. The dollar was down. We're back below 100 again, and interest rates are also down. We closed at 4.31% with the 10-year yield, where after Monday we were at 4.34%. Sentiment is positive, though. Even with the down day, it was unchanged. We're still at 57. And we're back to being inverted again with the 10-year to the 3-month yield curve. All right. And then we're negative now with the ADX, both in the short term and in the intermediate term. We are still above 20, though. Even though the ADX is coming down and it's below its moving average, that suggests the trend is weakening, but it's still a trend in the intermediate term. And with the down day, the bias is negative, and the momentum, which are the last number of days taken together, it had been positive. I'm changing that over to mixed to positive because it still looks like a pullback for right now, but we are going down. All right, the economic reports that came out, just the trade balance, minus 140.5 billion. Apparently that's a new record. This is probably imports coming in before the tariffs really kick in gear. So there's some front running going on there, and much more than expected here, and also much more than what we saw last time. Here are some charts to go with that. And you can see the nominal trade balance really dropping off here. These numbers are becoming more negative as we're going down. And then year over year, the nominal exports and imports, these are going up. Again, this could be some front running ahead of the tariffs kicking in. And then the trade deficit just coming down, setting a new record here. All right, then Isabel Net with the overbought, oversold composite put out by Simple Advisor. We had come all the way down to 7.71. That's when things were pretty bad in April. We have been rebounding, and we're just about up to 50. This turns more positive if we cross back above 50. Discretionary versus systematic strategies. Discretionary, these tend to do better when the market's going down because you can decide, well, I better get out now. It's at your own discretion. This doesn't have to do with the discretionary sector. Where the systematic approach, that tends to work better when we're going up, and it works worse here, the blue line, when we're going down, but both have been bouncing back up right now. And then the breadth of beats remains above average in the first quarter, even though it's coming down and they're projecting it to come down. Those companies that are coming out with their earnings and they're beating the estimates. That's really what's being measured here. And that's a common trick. You know, they come out with their guidance and their forecasts and they give you a number. And then when they come out with the real report, it's like, oh, they're better than they said they were going to be. Maybe we'll get a nice little pop out of the stock price. Well, it's something that happens, and a lot of people do short-term type strategies around earnings plays. I don't do them myself because it's a roll of the dice. You can have a bad report like we saw with Tesla, and the stock can go up because they announced Elon Musk was going to be taking more part in that. And then you can come out with a really good report and the stock goes down. So it doesn't really go with logic all the time. Then the shares of the S&P 500 companies providing forward earnings guidance during reporting season, and it's dropping off. a little bit here. They're like, we're not quite sure. We have to rework the numbers here and figure out what these tariffs are going to do, not only for the full year guidance here, but just looking out to the next quarter because there's a lot of confusion currently. And then this is old news now, but this was a Bloomberg chart saying that it's the longest win streak since 2004. We had 9 days there. Back in 2004, I actually remember that period of time when we had 9 straight up days there. And then Buffett's favorite valuation, apparently he's going to be retiring. There's an indicator called the Buffett indicator because he said he liked it. He didn't create it. And if you really pressed him about it, I used to show it on here with a site, but they changed the site and it's not as accessible anymore. This is looking at the Wilshire 5000, which I do show a chart later on. That's a broad market measure divided by the nominal dollars of GDP. And that comes up with a figure here. And it's been coming down as stock prices have been coming down as well. And this I go over in the weekend, usually in the weekly video. We look at the probability. It's a 95.6% chance that the rates are going to be the same. They're at 4.25 to 4.5 right now, and they expect them to be at 4.25 to 4.5 after the meeting is done. And then this is from a slightly different source here. This is called the Red Book, and this looks at retail sales. And if the economy was not doing all that great, we would expect this number to go down. It's actually been holding up quite well. People are still spending. And then American credit risk. We're seeing a lot of this. Yesterday, Scott Bessent talked about how the job is to take away the credit risk of the US government. Looking at this chart, he's got a lot of work to do here. A lot of people, they're having to live off credit cards right now. And then the earnings per share breadth suggests that the Fed should be cutting mode, not pausing. Okay, that's probably a matter of opinion and also how people interpret things. But the revisions are coming down, and Trump has come out and said the Fed should be cutting rates. And you can say all you want, but it's what kind of perspective are you looking at here? And according to this chart, there's justification that the Fed should come in and cut rates even more. But again, we have to look at the context as to why are they cutting rates? Are they cutting rates because the economy is going down or just to kind of keep the economy chugging along? We're kind of on the verge of going from one into the other, from chugging along like we saw last fall to, okay, if we see weaker than expected economic reports, they could cut rates for that reason. Here is the intraday chart where not an awful lot of action. We kind of started and stopped at about the same spot. It was kind of like a roller coaster ride here. We did gap down below S1. We gapped down and immediately went down to S2. And this is the 5,600 level. And this is where I said they may have come down here long enough to take out some stop loss orders here. And then we were able to bounce back up, tick off all these people right here. We ended up not really doing all that well by the end of the day, but this would probably make you short-term mad here. Got back up. We tried to get all the way up to the unchanged level. That was a resistance level. Came back down, kind of danced along S2, tried to get back up to S1, and then closed down at S2. So it was a pretty robotic day as far as price movement. And we are up in the initial overnight session. So maybe we'll get at least an initial bounce if the futures can hold on to their prices by the time we actually open. We're still looking okay here. The blue line is above the red line, even though they're coming down. We want the blue line to be outperforming. That means on an intraday basis, growth is outperforming value. And that's what we want in a positive environment. Also, still improving here with the intraday chart between growth and value with the S&P. Overall, the trend has been up, even though it was down in Tuesday's session. So our end of day charts, growth was down more for the large caps, mid caps, and down less for the small caps. So looking at the end of day growth to value ratio, we're still above the moving averages here, showing some improvement, even though this did come down slightly on Tuesday. Came down a little bit with the mid caps, but we're above both of the moving averages. We're still in a downtrend here with S&P growth to value, but we're above both of the moving averages, even though it ticked down a little bit. And we're still inside the rainbow here with this growth to value ratio measure. Looking at discretionary, just it needs to do better. It's been bouncing back up, but still can't seem to get above either of these moving averages now. This is a different chart of kind of looking at that same thing where we have the S&P on top, and then in blue is the defensive sector, and you can see how it has been outperforming here. That's when I talk about the market's getting more defensive. These are toilet paper, toothpaste type things, things that the market gets into when they think we're going to go down. And then the offense sector, this is growth. And when this is outperforming, that's when the market is doing more positive. And you can kind of see here, there are some times when this gets a little bit out of line. They both can rise at the same time, but this measures the spread between offense and defense, and we're coming right back up to the midpoint now. And we're seeing here, this was actually lining up with the lower low that was set earlier on this chart. So looking at our trend, we are back to negative. We switched to positive after Friday, but then after Monday and now after Tuesday, we still have the red line above the green line. So the intermediate term trend is negative, but it's weakening because it's coming down and it's below the moving average, and we're still just barely above 20. Where we're below 20 in the short term, we're also negative here. The red line is above the green line, but now in the short term, we're technically not trending right now. And we still tend to be below average with volume as measured by this next chart as well. We have a below average bar here. Sentiment, we're back above 24 with the VIX. If we have a down day, the VIX goes up. If we have an up day, the VIX goes down. We're still above 20 overall, and we tick back up here with the VIX of the VIX, just measuring how the volatility of the VIX is doing. But the momentum of the VIX still continues to be down as measured by the MACD. This I usually show over the weekend, but they started putting this up on a different day at IsabelNet, the blog charts that I show, showing an improvement of sentiment. We're still below zero here. That means they have negative sentiment according to this. If we go back above zero, that means sentiment is turning more positive. And we're just pretty much unchanged here with this fear gauge. And we were actually up a little bit here with this other fear gauge with the decline. And I show this over the weekend as well, but they put this out at a different time now at IsabelNet. Seeing for the 10th week in a row now, individual investors continue to be extreme negative on the market. They're camped down here. We use this like a contrarian indicator where we come down here, it's a blow off bottom. Everybody's freaking out, and then we bounce up out of that. That's not what's been happening this time. Now that we've had a couple of good up weeks, we'll have to see in the next survey if there is an improvement. And we did go up with the daily chart of the equity put call ratio. We're going up with the 5-day chart and starting to turn back up with the 10-day chart as there's been an increase in hedging with the declines in Monday and Tuesday session. Still getting a low reading, but starting to turn up with volatility risk premium. We'll see if that picks up and may suggest there might be some fear looking out. The advanced decline line is coming down, but still positive. We're still above advancing moving averages based on price and volume, coming down and not quite extreme anymore with the advanced decliners oscillator that we have here. This had become, it actually went up after Monday, but now it really came down after Tuesday. And so this might suggest that we're due at least for maybe some sideways action. Now, sometimes it could signal a reversal, but that's why we look at other charts to try to come to that conclusion. And we were extreme with the advanced decline ratio. That's now coming down, but both the short and intermediate term are still above zero and still tapering off a bit here with the new highs, a little bit of an expansion of the new lows. But even though it's coming down, the 5-day is still going up, but the 10-day is now leveling off. That's the internal measure of the market. And we're actually turning, it depends on how you look at this chart. And I'm actually showing a chart that I include in a newsletter here, or I have more annotations. And if you want to have access to that newsletter, click on the link right below this video. We're coming down with accumulation distribution. Now, when we're above the red line, that's positive. But then we measure, okay, what is the direction as it's coming down? We use a modified MACD here, and it's dropping below its moving average. So if you're more aggressive, you're turning to negative with accumulation distribution. If you're more conservative, we're still above the red line, so you're still positive if you look at it that way. We're still going up with the Chaikin money flow, so that's positive. This is smart money indicator number 2, but we're still declining with the Chaikin oscillator, which is smart money indicator number 3. And we are also still positive, but coming down with the green line, coming up with the red line. When we look at the vortex, this is a primary indicator. And we're coming down, but still above the moving averages with all the major indexes that we look at here. And no longer extreme with those stocks inside the S&P above their 20-period moving averages. We have worked that off now. We'll be waiting to see, is this going to drop even further, or is it going to settle down and just mark that maybe we're going to go sideways for a while? And we're still above 50, but declining with the 50-period moving average study. We're below 50 with the 100 and 200-period moving average study. Here is the daily chart where we're still above the 50-period moving average. We ran into this overhead pivot point here, and that was pretty much the top, right at about 5,700, and we've been coming down since then, but we're still hanging out above the 50-day moving average. We continue to be below average with volume. So a little bit of a downturn here with the 20, 50, and 200-day moving averages on the S&P. Coming down, but still extreme with the Williams percent R or the Stochk RSI, just barely coming down from extreme positive territory. No longer extreme with the CCI 14 or the CCI 20. Those have dropped off our list now. But in the short term, intermediate term, and long term with the stochastics chart, and these are further subdivisions of the short term time frame, coming down in the short term, rolling over in the intermediate term, still going up with the long term stochastic. Coming down, but still positive with the force index. We're coming down below this green line, but we're still going up with both lines when we look at the condition of the short-term trend. That's still positive for now, and we're still above the 20-period simple and exponential moving averages. So that's why we're positive in the short term. The rate of change going back 10 days is dropping, but still extreme. And we're coming down into the +1 channel now after we had been in the +2 channel with the standard deviations chart. Intermediate term, still looking okay here with the balance of power. That's positive. Still seeing more brown, which is possibly a shift from negative over to positive with the go, no go. And still above the midpoint with our highest high, lowest low value chart. Looking better here. The longer we stay above these lines, the more this quicker fluorescent green line, that's a 10-day simple moving average, and it moves quicker than the 20 and 30 exponential moving averages. So this is showing an improvement here. If we fall back down below this, the lines will eventually roll back over. But as long as we stay above these lines, that's suggesting that the short to somewhat intermediate term trend is still hanging on to being positive. And we're positive here with the Landry light. We are seeing green bars here, but we're still negative with proper order. This is a little bit longer term indicator. It has a red background, that's negative. And the TTM squeeze, after being really extreme, has now turned to dark blue. That means it's more negative. And here's a longer term look, much more of an extreme reading to what we've seen on this chart. If this continues to come down, that's going to be more negative. And the rate of change in the intermediate term, going back 20 periods, declining slightly, but still above this red line. It's still extreme positive. And we're coming down with the standard deviation, but we're still above the moving average. This measures speed, not direction. And we're coming down, but still barely positive with the ease of movement. And we're still positive with the Arun. We're above zero when we measure the buyers versus sellers here. And so that's hanging on to being positive for right now. Coming down with the S&P McClellan oscillator, that's now no longer extreme. After Friday, it had been extreme. So that's coming down, but it's still above zero. So it's still positive when we look at the summation index. These are also more annotated charts that I include in the newsletter. And it's $8 a month if you want to subscribe to that. But we're going up based on price and volume. And we're no longer extreme with the NYSE McClellan oscillator, but it's still above zero. So we're going up with the summation index based on price and volume. Coming down with the Swindling Trading Oscillator. That is turning more negative. I thought I updated this one. But momentum is still looking positive. With the PMO going up, we're going up based on price and volume there. We're no longer extreme positive with the PMOs that are rising, but the buy signals are still extreme. And we're still continuing to go up with the PMOs above zero. And we've still remaining neutral with the Elder's Impulse system for the S&P, and we're still positive with the parabolic SAR since the dots are underneath. The intermediate term trend is hanging in there for right now. We're above the blue line and the red line, so the lines are going up. and we're above the simple and exponential moving averages. Now, if we see more weakness from here, we're going to be watching one of these to see if this ends up providing support. And we're actually dealing with overhead resistance with the 100 period exponential moving average. That's the red line. And here, further annotated here, we're just kind of in the middle of all these crazy moving averages. Rolling over, but still extreme positive with the slope oscillator. That's short term. Still going up with the MACD and above its midpoint. That's positive. And so we're concerned about the slope oscillator, but our other short-term oscillator is still looking okay. And we're still looking good in the intermediate and long-term oscillator library there. And we're starting to look a bit extreme here. The Copic curve is still going up. And so I wanted to include this longer look. This goes back and just shows other times when the Copic curve started to top out. There's really no defined range for this. We just kind of eyeball it compared to what's happened before. And actually coming down, but still more neutral with the Sean trend meter, coming down, but above 50 with the money flow and the ultimate oscillator, still above the moving average with unbalanced volume, and the moving average is going up. And we're still above 50 with the RSI 14 and the RSI 9. And we're coming back down here with the bullish percent index. After we had gone barely above 70, it's starting to pull back now. So we just want to keep an eye on that one as well. But we're down just a little bit here with the NYSE bullish percent index coming down, but still extreme positive with the NASDAQ 100 bullish percent index. And we're still dealing with the 61.8% retracement level. That's where we hit on Friday. This was pointed out over the weekend, and we've been coming down. Now, if we do see more declines, we'll be watching this 50% retracement level to see if that provides some kind of support, and that's at the 50-50 level, which has kind of been a big level that the market has been dealing with. And we're still above the pivot point here. Now, that's at 55.75. That's the value for the P, where we're at 56.06 or '07 right now. So we're still 20, 30 points above that currently. We're actually turning a little more positive here with the Heiken, or excuse me, negative with the Heiken Ashi with the dark candle, but we're still going up with the Kegi chart. It's black and pointing up. We're still positive with the Renko chart, and we're still positive with the 3-line break chart. Long term, coming down a little bit with the 150 and 200 period moving averages, but still above these green lines. And we're still positive in the short term with all the different stock indexes. Intermediate term negative, still negative with the mid caps and small caps, and still negative across the board when we look at the price of bonds, commodities, and the dollars on all time frames. And we had utilities and energy. Energy bounced back up just a little bit. It's really been suffering. But utilities, again, you could make a case that that's a growth area since we need so much electricity now. But it's typically been more of a defensive area where we have healthcare just getting hit. That's a defensive area. Discretionary was down. Staples were down. Communication was down, but virtually unchanged. And tech ended up being down a little bit more. So we're seeing a little bit of a hit coming in here. An awful lot of red. Just Canada was able to get back above 25,000. But we had the NASDAQ going below 17.8, 17.7, 17.6. The Dow going below 41,000. The S&P near the open was down below 5,600, but it recouped that. And we had a BPI cross down below 70. That's the chart that I just showed a couple of minutes ago. This is a newer chart. I resisted using these for a long time. This is called a market carpet. I'm going to start including that now. And for some of you, you might find this helpful. Others are like, okay, I'm just seeing a whole lot of crazy boxes here. But these are the 11 S&P 500 sectors. All 11 are represented here. And then you can see the biggest area, tech, that's the biggest part of the stock market. And then the biggest part of tech is Microsoft, Apple, and NVIDIA, or are Microsoft, Apple, and NVIDIA. Then we have the financials, and then the big areas there, discretionary, healthcare, communication. You can see an awful lot of red here. But energy, that was up, so we see more green. Real estate was down, and then staples, a few positive, a few negative areas there, and then industrials as well. So see if this helps you from more of a visual standpoint. And we're still coming back down after hitting the 50-period moving average with the Dow. We're neutral with the diamonds with the Elder's Impulse. And we're still above the 50-day moving average with the NASDAQ, but we are in a downtrend. We're still neutral with the NASDAQ with the Elder's Impulse system, still above the 50-day moving average of the NASDAQ 100. And we were seeing a convergence. The NASDAQ 100 was hitting the 50-day moving average, and then actually that's the 200-day moving average. Sorry about that. We hit that, and then we've been coming back down. We were also getting close with the S&P with some resistance areas, and they were kind of all coming together, plus being overbought all at the same time. And we are still neutral with the Qs when looking at the Elder's Impulse system, but the momentum for the NASDAQ 100 is still positive. And we were hitting the 50-day moving average with the small cap S&P 600. We've been coming back down there, but we're actually dropping below the 50-day moving average with the other small cap index, the Russell 2000. Neutral with the Elder's Impulse system for the small caps, actually holding up a little bit of support above the 50-day moving average with the mid caps, but going from positive to neutral with the Elder's Impulse system, above the 50-day moving average with the Wilshire 5000, and also still above it with the total US stock ETF. Financial sector was down 0.5%, but still above its 50-day moving average and still in more of a defined uptrend, and still above both of the moving averages here with the FANG index. Apple is in a downtrend and was down 0.19%. It's been getting hit pretty hard lately. It tried to bounce back up to its 50-day moving average and has now been coming back down. And Amazon is in a downtrend, also seeing its 50-day moving average be resistance. Microsoft is still in a downtrend, but after they reported earnings, they've been actually bouncing back above both their moving averages. Meta getting close to a downtrend here, but still barely above its 50-day moving average. Google's in a downtrend, also hanging out around its 50-day moving average. Nvidia a little bit right here near its 50-day moving average, also in a downtrend. Tesla in a downtrend underneath its 200, still above its 50-day moving averages. Netflix was back up again. It's probably the strongest looking chart. And coming down just a little bit, but seeing a pretty strong correlation in the short term between US and world stocks. A little bit of a tick up here, but pretty much flatlining when we look at the longer term correlation. This is something that I've been harping on for quite a while. This is the SPY, which is the ETF for the S&P 500, to staples ratio. Staples are defensive, toilet paper, toothpaste. We saw this really break down at the end of 2021, and then we went into a bear market in 2022. We're seeing a similar kind of thing happening now. We're just watching this to see, is this something that's going to develop and eventually get us into a bear market? Oil ticking back up just under 60 right now after it had climbed into the more mid 50s. And the dollar is back below 100 and also in a downtrend. Here's the Truflation gauge of inflation now. It's coming in at 1.58%. And we were down with the 10-year yield. We were up with the 10-year based on price. We're back to being inverted with the 10-year to the 3-month yield curve. And we're still looking okay with our Q to S&P growth to value ratio here. Also looking okay with large cap growth to large cap value on the bottom, but we're not looking really good with discretionary to the S&P. But when we look at the large caps, mid caps, and small caps, seeing a bit of a hit here, but still above advancing moving averages. So what's our outlook for Wednesday? We're still positive in the short term because we're above the 20-period moving average, and we're still positive in the intermediate term because we're above the 50-period moving average, but we're negative in the long term because we're below the 200-day moving average. And we're going to have the MBA Mortgage Applications Index. That comes out every week. Consumer credit, and we'll have to see how that goes. And then the FOMC rate decision will be at 2 p.m. Eastern time. And then anything else. Maybe things will calm down in the Middle East based on what's happening over the last few days, what kind of announcements come out of the White House concerning tariffs and trade wars and so forth. And here's the economic calendar. The big thing on Thursday will probably be initial jobless claims, productivity, and unit labor costs. That can be influential too, given what we're focused on these days with the economy. And then here's some other things. Crude oil inventories will come out. I usually don't focus on that. And then the different things coming out from the Fed. Seasonally, we're positive with the Dow and S&P for May 7th, neutral to positive with the NASDAQ. And seeing some positivity here, a little bit of a tick down during a post-election year, but all eyes are going to be on the Fed right now. Now we'll have to see if there have been times when usually things are pretty quiet and then they come out with an announcement and then we gyrate all over. Maybe the market feels that it already knows what the Fed's going to say, but there's so many variables right now with the tariffs and the trade wars and everything. You don't know what could come out of that meeting or what they're going to say about the tariffs. And then here are the pivot points for Wednesday's session. And I'm starting to include this chart. Now, this only calculates R1 and R2, S1 and S2. If you need, because there are times when we go above R2 or below S2. And if you need to calculate any of the R3, S3, R4, S4, I put the website here. It's pivotpointcalculator.com. All you have to do is put in the open, high, low, close for the previous day, and it spits out these other pivot points. The software here, it only calculates up to R2 and down to S2. So what are the warning signs? We're still concerned about this S&P longer term growth to value ratio, as well as the discretionary to staples ratio. The swollen trading oscillator's negative, and the moving average studies, the 100 and the 200 are below 50. The 50 is slightly above 50, but declining. And the 20 period moving average study is now declining after being extreme positive. And then the long-term special K chart, which I show over the weekend, is negative there. And we're getting a mixed picture with our smart money indicators, depending on how you interpret accumulation distribution. We're above the moving average. That would make it positive. But the boom indicator, we're dropping below the moving average. So if you're more aggressive, you've already turned negative with that indicator. But the chicken money flow actually had a pretty good day. And that's positive. And the chicken oscillator is negative. So no matter how you interpret the accumulation distribution, you're still getting mixed pictures when you look at the second and third. And I use these as one unit together. That's why I have this bracket over here. And we're still positive, even though we're declining with the McClellan oscillators and summation indexes for the S&P and NYSE. The bullish percent index is starting to come down after being extreme. We're still extreme with the NASDAQ 100 bullish percent index. Parabolic SAR is positive. We are still positive with the 20 period moving average study, but it's now declining. And we're still positive when we look at momentum. In fact, we're extreme positive with the slope oscillator. Ease of movement, money flow, and ultimate oscillator. Those are secondary indicators. That's why they're in white. They're positive, but the vortex, another primary indicator, is still positive. The financial sector is holding up, and the momentum for the NASDAQ 100 is holding up. So our conclusion, we are still positive in the short and intermediate term. We're negative in the long term, and the decline is continuing. We're coming down in the short term after being overbought and hitting overhead resistance. And we are just, right now, anyway, it looks like a pullback in the intermediate term. If we lose the 50-day moving average, that's going to change things. So you want to be watching that level, and we're still negative in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.